Hello guys, welcome to my channel. Today I am going to talk about Basel. So if you are new to this channel, immediately subscribe to it because if you do not subscribe, you will be missing a lot of important content for exam. So today let's get our topic started without any delay. So our topic of content for today is the introduction about Basel. Basel first, second, third, and their various provisions, measures followed in Nepal, and what are the challenges for its implementation. So what is Basel? Basel is actually a name of a city of Switzerland, and Basel Committee on Banking Supervision was formulated by central bank governors of G10 countries in 1988 after serious problem in currency and other related to the banking system and overall economy. Okay, so before 1990 the soundness of a bank was measured by the help of leverage ratio, that is capital divided by total asset. But here the asset was not in terms of its risk weights. Okay, so capital was put on the basis of the asset, not on the basis of the risk weight. Assets. So Basel first. So what were the provision of Basel first? The provision of Basel first was that all financial institutions should hold the capital at least 8 asset. Okay, so what does it mean? It means that as per the nature of the asset, the capital should be kept. Suppose if the risk weighted asset, if the asset is government securities, then bank poses no risks. So in such cases, capital will be 0 because risk weight of government security is 0. Similarly, if risk weight of certain asset is 100%, then banks will place additional 8% of that risk weighted asset. So as per Basel first, capital ratio was given by capital divided by the risk weighted asset, and the only risk Basel first included was the credit risk. It did not consider operational risk, liquidity risk, and other types of risk. Similarly, Basel II was implemented in 2004, and what does the Basel II did was that it changed the existing Basel into more risk-sensitive Basel. So as per the Basel II, risk-based capital was given by capital divided by credit risks, market risks, and operational risks. So in earlier Basel first, 8% capital requirement was only for credit risks, but here 8% capital requirement was for both or all credit risks, operational risk, and market risks. The three pillar concept of Basel II consisted of minimum capital requirement, supervisory review process, and market discipline. So minimum capital requirement is that 8% of risk weighted asset. Supervisory review is that the bank should have adequate supervisory review of its process, procedures, control systems, so that it has all that is necessary to put this approach into work. Okay, and market discipline means that the bank and financial institutions should adequately disclose their reporting requirement. Okay, so it is related to disclosure requirement about transparency, you can say that. So another thing what is that credit risk mitigation technique brought about by Basel II was that by using credit swap, you can as well as guarantee and other collateral, you can minimize the credit risk of deferral. Credit risk of default. Summarize the Basel thought. So Basel thought actually increased the quality of capital. It brought about the liquidity requirement which was missing in Basel second. It brought about the reserve requirement, additional reserve requirement, buffer requirement, which was not in Basel second. Likewise, sci-fi measure and liquidity coverage ratio. So now, what is the measures followed in Nepal? In case of Nepal, for the credit risk mitigation, simplified standardized approach is followed. So what does it mean? It means that there are basically two things. One is stress testing. So stress testing basically means that the bank and financial institution study the trend of the past years, historical trend, and on the basis of that, it analyze that what will happen to its overall capital adequacy ratio if certain variables are changed. For example, if interest rates rises, or if price rises, what are going to be its effect on its overall capital adequacy framework. So stress testing is done basically, and another is rating is given. So as per the rating given to the bank, the risk weighted asset is given, and as per the risk weighted asset, capital is formulated. Okay, so basically we will talk about this in detail in our coming classes, like NRB directive, capital adequacy framework directive number 1. Okay, so now for operational risk basic indicator approach, so here the gross income of 3 years is taken as average, and by using that, operational risk weight is calculated. Okay, and net open position approach for market risk, it is a difference between the foreign exchange asset of 1 year with the foreign exchange liability of 1 year. So capital charge for market risk is calculated by that way, by using the foreign exchange asset and foreign exchange liability. Okay, so basically there are liquidity risk approach also, where liquidity coverage ratio is there, net stable funding ratio is there, like I discussed earlier. Similarly, net liquid asset is there, and other measures followed in our country, which we'll be discussing in our next topic of NRB directive number 1. So what are the challenges for the implementation of Basel? Is that the poor supervisory capacity. So our especially the regulator do not have strong supervisory capacity, so they need to enhance their supervisory capacity. NRB should enhance its, Nepal Rashtra Bank should enhance its on-site and off-site supervision capacity as well as real-time supervision capacity. So mostly the supervision is quite centralized, so it should be more decentralized, more real-time, like updated and timely response to the banking system is necessary. Likewise, another challenge is the poor governance that we hear frequently in terms of like in terms of credit lending to given to interested party, in terms of board pressure in the day-to-day activities of the bank, so such kind of conflict of interest and poor internal control system, all are hampering our governance system. So unless we build our proper governance, Basel thought couldn't be implemented properly. Similarly, lack of proper board database. Okay, our database management is very weak. We do not have properly fully digitized database. So we still rely on our manual database, and which is not reliable, which is not durable. Like with credit rating, we only have two credit rating agency in our country, so these are very few. Okay, so credit rating of the banks and credit rating of the projects, so that is what we are lacking. So credit rating agencies should be more in number. Likewise, their performance should be effective as well. Similarly, lack of reliable data, like our our banking system technology is not quite advanced, not in all banks. Okay, we still rely on our traditional software, traditional core banking system. So because of which reliability could be an issue. Similarly, likewise, our data recording, our data maintenance is not quite modern. Okay, data are not timely updated, data are not properly recorded, they are recorded haphazardly, randomly, and mostly manual. So all these factors are the challenges for the implementation of Basel provision in the context of our country. Okay guys, so that is all about Basel and its provisions and our challenges, measures, practice. We will be discussing more about this topic in our coming chapters in relation to our NRB directives that we will be discussing later on. So if you have any queries, kindly comment your queries. I would like to address them soon. And thank you for passionately listening to my class. Thank you guys.